In 2023, the year started with concerns about a recession and shifted to worries about high inflation. But instead of the bears, we got a Goldilocks zone with the economy reaching a soft landing and markets facing one of their most optimistic outlooks ever. The good news and bad news about that is that for the first time in 20 years, assets from bonds to stocks to cash have converged on yields between 4 and 5%. The bad news in that is that it doesn't leave us many asset classes to look to if we want to get higher returns than that, even though they are good on a positive real return basis when we adjust for inflation. The Fed is centering right now on, the market is centering right now on the Federal Reserve and a belief that they have to lower interest rates. And in fact, when we look at the data, they do need to lower interest rates, but they are haunted by the specter of inflation coming back in the 70s when they did that. So I think they're going to bias towards keeping rates higher for longer before they lower them. If the market doesn't like this, we could see a bit of a sell-off, although there is a lot of cushion because the Fed now has the ability to lower interest rates. And additionally, earnings are solid, the consumer's in great shape, jobs look good, things look good for the economy across the board. When we look at what that means, we find that we are in what we call the mid-cycle growth or late-stage growth cycle. The sectors that do well are tech and energy in those cycles historically. Tech is tricky right now because you may have heard of the Magnificent Seven stocks. There are 7 stocks, all of them technology firms, Microsoft, NVIDIA, firms like that, that are driving all of the gains in the S&P 500. And should they stumble, the market may not have other players that can come along and keep the market at its current high levels. Energy is also an interesting arena because it tends to do zigs when the economy zags. So there's a good risk buffer there, although these companies' valuations are pretty strained right now for a lot of reasons, but they are producing a lot of cash, which could lead to good dividend yields. We spent a lot of time last quarter working hard to adjust to the new normal that we're seeing in the economy. And accordingly, we feel we're well positioned, especially in fixed income, to continue to prosper and grow. As always, we invite your questions or comments, and we value working with you. So I thank you, and I wish you and your families a very happy New Year.